Welcome to the deep dive. Today we're getting into something pretty significant for a lot of folks. Moving retirement money, your 401ks, your IRAs from the U.S. to India.
Yeah, and doing it smartly, tax-wise. It's a big decision, and honestly, there's no one-size-fits-all answer. It really depends on, well, your specific situation.
Absolutely. So the aim of this deep dive is to kind of cut through that complexity. We want to unpack the U.S. and Indian tax laws, look at that crucial U.S.-India tax treaty, the DTAA.
Right, the Double Taxation Avoidance Agreement, and explore strategies you might use to, hopefully, minimize those taxes and penalties.
We've looked at quite a bit here: U.S. retirement account rules, IRAs, 401ks, that early withdrawal penalty.
And the exceptions, like SEPP, which we'll get into, Roth conversions too. And then on the Indian side, the tax rules for NRIs, residency status, how foreign income is treated.
We even looked at what people are saying in financial communities' expert takes to try and give you a full picture.
So let's get started step by step.
Okay, first things first. Accessing those U.S. retirement funds early, before that magic age of 59 and a half. The big scary thing is usually that 10% penalty, right?
Generally, yes. If you take money out of most qualified plans, 401ks, traditional IRAs, even Roth IRAs in some cases before 59 and a half, there's typically an extra 10% tax.
On top of regular income tax.
Exactly. And importantly, it's on the part of the withdrawal that's considered growth income. So if you made non-deductible contributions to a traditional IRA, for example, that portion wouldn't get hit with the penalty when you take it out.
Okay, so it's not always the full amount, and there are ways around this penalty exceptions.
There are. We'll dig into the ones most relevant for moving abroad soon. But first, maybe the simplest path, at least initially.
Just leave the money in the U.S.
Precisely. That's strategy one. You could just keep your funds in your U.S.-based IRA, or if you've left your job and the plan allows it, maybe even keep it in the old 401k.
And don't forget Roth IRAs. Your contributions, the money you put in, can always come out tax-free and penalty-free, right?
Correct. It's the earnings in a Roth that could face taxes and penalties if withdrawn too early or before meeting the rules. But the contributions are yours to take any time.
Plus, leaving the money there allows for potential continued growth. Tax deferred for traditional accounts.
Or potentially tax-free growth in a Roth if you follow the rules. So your investments can keep working for you without immediate U.S. tax hits.
But there's a catch eventually, isn't there? RMDs.
Yes, required minimum distributions. For traditional IRAs and 401ks, you have to start taking money out eventually, currently starting at age 73.
Which could trigger taxes then.
It will trigger taxes on the pre-tax amounts withdrawn. A big plus for Roth IRAs, though the original owner doesn't have RMDs during their lifetime. That's a nice perk for long-term planning.
Okay, but leaving it in the U.S., you have to ask, does that still make sense if your life is now based in India? Do U.S. investments align with your goals there?
That's the core question. Where will you need the money? How do investment options compare? Currency risk is another factor, the dollar versus the rupee.
Right, the exchange rate swings.
So leaving it might seem easy short-term regarding penalties, but does it fit your actual financial life in India? That needs careful thought.
Okay, so if leaving it isn't ideal, and you do need the money before 59 and a half without that 10% hit, strategy 2 comes into play, SEPP.
Yes, substantially equal periodic payments, or SEPP. It's based on Section 72 of the U.S. Tax Code.
Sounds technical.
It is, a bit. But basically, it's an IRS-approved way to take penalty-free withdrawals before 59 and a half. You take them as a series of payments, roughly equal, spread out over your life expectancy.
Okay, substantially equal. What are the key rules here? A must-dos.
Crucial rules. First, if the money's in a 401k or similar plan, you must have left that job separated from service before the SEPP payments start. This doesn't apply to IRAs, which is a nice bit of flexibility there.
So you can start SEP from an IRA even if you're still working elsewhere.
Correct. Second big rule. Once you start a SEPP on a specific account, that's it. No more contributions to that account. No other withdrawals from that account. Just the SEPP payment.
Wow, okay, so you can't just dip in for extra cash if something comes up.
Absolutely not. Doing that busts the whole plan and triggers penalties. Interestingly, changing your investments within the account is okay, but no money in or out beyond the plan payment.
And the third thing?
You can only have one SEP plan active per account per year.
It sounds pretty rigid once you start. How do you figure out how much you actually get each year?
The IRS gives you 3 ways to calculate the payments. Method 1 is the required minimum distribution, or RMD method.
Like the RMDs for older folks.
Similar concept, but uses a different life expectancy table usually. You basically recalculate the payment each year, Divide the account balance from the end of the previous year by the life expectancy factor for your current age from the IRA single life table.
So the payment amount changes every year.
It does. Because your age changes, the factor changes, and your account balance will likely change due to investment performance.
Can you give us a quick example?
Sure. Let's say you're 50, you have $600,000 in an IRA. The IRS table factor for age 50 might be, say, 36.2. So $600,000 divided by 36.2. That's roughly $16,575 for the first year.
Okay.
Next year, you're 51. Let's say the balance grew to $620,000. The factor for 51 might be 35.3. So $620,000 divided by 35.3. Now it's around $17,564. It fluctuates.
Got it. That variability might be tough for budgeting. What are the other methods?
Method 2 is the fixed amortization method. This one calculates a fixed annual payment amount right at the start, and you get that same dollar amount every year.
Ah, more predictable. How's that calculated?
It uses your starting account balance, your life expectancy factor when you begin, and a permitted interest rate. The rate can't be more than the greater of 5% or 120% of the federal midterm rate for the 2 months before you start. It involves some present value math, but the result is a steady payment.
Okay, like an example.
Say $750,000, you're 45. Let's assume a 4% interest rate. The life expectancy factor for 45 is 41.7. Running the numbers, you might get something like maybe $25,000 a year fixed. That amount stays the same. That does sound easier to plan around. And the third method.
The fixed annuitization method. It's similar to amortization in that it also gives you a fixed annual payment.
How's it different?
The calculation is slightly different. It divides the account balance by an annuity factor, which is based on mortality tables, and a permitted interest rate. Think of it like figuring out what an immediate annuity bought with that money would pay out each year. Same outcome, fixed annual payment.
Now, I heard there was a relatively recent change about the interest rates you can use. Notice 2022-6.
Yes, that was a helpful update. It clarified you can use an interest rate up to the greater of 5% or 120% of the midterm applicable federal rate, the AFR.
And why is that good?
Because sometimes 120% of the AFR was quite low. Setting a floor of potentially 5% means that for the fixed methods, amortization and annuitization, you might be able to calculate a higher allowable annual withdrawal amount than under the old rules, especially when interest rates are generally low. Makes SPP potentially more attractive if you need a larger income stream. More flexibility on the upside, okay. But we keep coming back to the downsides. Remind us of the biggest one.
The inflexibility. Once you start SEPP, you are locked in. You must continue the payments for at least 5 full years, or are, until you reach age 59 and a half, whichever period is longer.
Whichever is longer.
So if you start at 58, you can't stop at 59 and a half. You have to go until you're 63, 58 plus 5 years. If you start at 52, you have to continue until you're 59 and a half, which is longer than 5 years.
And if you break the rules, stop early, take extra money.
Big penalty. It's a recapture tax. The IRS basically goes back and charges you the 10% penalty you avoided on all the SEP payments you received up to that point, plus interest on those penalties.
Ouch, that could be substantial.
It really could. It's a serious commitment.
What if you have an emergency? Is there any way to manage that risk?
One strategy people use is splintering accounts, meaning maybe you don't put your entire IRA into a SEP plan. You could split your IRA into 2, put one part into the SEPP for your planned income, and leave the other part separate.
Ah, so if an emergency hits, you tap the non-SAP account.
Exactly. You'd still face the 10% penalty on that emergency withdrawal if you're under 59 and a half, but it wouldn't blow up your SAP plan on the other account. Gives you a bit of a safety net.
That makes sense. Now, online, people often compare SEP with the Roth conversion ladder. We see debates about which is better. What's the typical back and forth?
Yeah, you see that a lot. SEP's big pro is immediate access. No 5-year wait like the Roth ladder.
Yeah.
If you need income now after moving, SEP delivers penalty-free withdrawals right away from a traditional account.
And maybe larger withdrawals initially with the new interest rate rules.
Potentially, yes.
Yeah.
Depending on the math, SEP might give you more cash flow up front than you get from converting smaller amounts annually in a Roth ladder, especially if you're trying to manage taxes during conversion years.
But the big con for SEP is...
But in flexibility, we just hammered on. You're locked in. Any mistake is costly. The Roth conversion ladder, well, it has that 5-year waiting period for each conversion.
Right, each rung on the ladder needs 5 years.
It offers way more flexibility after that wait. Once a conversion is 5 years old, you can access that principal penalty-free before 59 and a half. And there's no obligation to take it out.
The other challenge often mentioned for the Roth ladder is needing bridge money, right?
Definitely. You need enough savings outside of retirement accounts to live on for those first 5+ years while you're building the ladder and waiting for the rungs to mature. That can be a huge hurdle.
So immediate but rigid access with SEPP versus delayed but flexible access with the Roth ladder, potentially requiring significant outside savings.
That's a good summary. The best choice really hinges on your immediate income needs, your savings level, your tolerance for rigidity, and your long-term tax outlook.
Okay, let's break down that Roth conversion ladder a bit more. Strategy number 3, what's the basic process?
Simple concept. You move money from a pre-tax account like a traditional IRA or an old 401k into a Roth IRA.
The key thing up front, you pay taxes now, right?
Absolutely critical. The amount you convert is added to your ordinary income in the U.S. for the year you do the conversion. So you're prepaying the taxes, essentially.
But the payoff comes later.
That's the goal. If you follow the rules mainly, being over 59.5 and meeting the 5-year rule for earnings qualified withdrawals from the Roth IRA in the future are generally federal income tax-free in the U.S.
Okay, now that 5-year rule for conversions, let's clarify that because Roth rules can be confusing.
Agreed. There are a couple of 5-year rules. The one most relevant for the conversion ladder strategy relates to avoiding the 10% penalty on withdrawn converted funds before age 59.5.
How does it work?
Each conversion you make starts its own 5-year clock, beginning January 1st of the conversion year. If you withdraw those specific converted funds within that 5-year period and you're under 59.5, you might owe the 10% penalty on that amount, unless another exception applies.
So, convert in 2024, wait until 2029 to withdraw that specific 2024 conversion penalty-free before 59.5. Convert in 2025, wait until 2030 for that bit.
Exactly. Each conversion has its own waiting period for penalty-free access to the principal before 59.5. This is separate from the rule about Roth earnings, needing the account open for 5 years to be tax-free.
Got it. So the latter strategy is convert a chunk each year, let each chunk age for 5 years, then start tapping the oldest conversions penalty-free.
That's the essence of it. You build up this series of conversion rungs over time. The big downside, again, is that delay. You have to start the process at least 5 years before you anticipate needing to access those converted funds penalty-free.
Going back to the SEPP versus Roth ladder debate, the idea that SEP might lead to a higher final balance, what's the thinking there?
It's complex, depends on assumptions. But the argument is, if SPP allows larger initial withdrawals that meet your needs, and you're converting smaller amounts to Roth to manage taxes,
then more money stays invested in growing in the SEP account longer.
potentially. If the SEP withdrawals are sufficient, and the remaining balance compounds well, and you don't bust the SEP rules, it's possible you could end up with more than if you'd converted more aggressively, paying more tax up front, or withdrawn more slowly from the Roth ladder later.
But heavily dependent on sticking to the SEP plan.
Absolutely. And investment returns, future tax rates, it's not a guaranteed outcome, just a theoretical possibility in some scenarios. The inflexibility risk of SEPP is always there.
A major practical issue with Roth conversions is that tax bill in the conversion year, especially if you convert a lot.
Huge consideration. Converting a large pre-tax balance all at once can easily bump you into much higher U.S. tax brackets for that year. That can be a painful tax hit.
So the common advice is,
If possible, spread the conversions out over several years. Convert smaller amounts annually to try and stay within lower tax brackets. It smooths out the tax impact.
but it also lengthens the time it takes to convert everything and build the ladder.
Correct. It's a trade-off between managing the immediate tax cost and the speed of getting funds into the Roth.
Okay, let's shift to another potential penalty exception. Strategy 4, the rule of 55. This one's just for 401ks, right?
Yes, specifically for 401ks and similar employer plans like 403bs. Not for IRAs. The rule says if you leave your job, quit, get laid off, retire in or after the calendar year you turn 55.
You can take money out of that specific 401k without the 10% penalty.
That's the gist of it. Penalty-free withdrawals are allowed from the 401k of the employer you just left.
Seems straightforward. What's the catch?
The absolute key thing is the money must stay in that 401k plan. If you roll it over to an IRA traditional or Roth, you lose the ability to use the Rule of 55 exception for that money.
Okay, so you have to be comfortable leaving the money in your old employer's plan.
Right. You need to consider the plan's investment options, fees, administrative aspects. If you roll it to an IRA, you're back to needing other exceptions like SEPP or the Roth ladder if you want penalty-free access before 59.5.
Good distinction. Now, regardless of how you access the funds, ACP, Roth ladder, Rule of 55, or just regular withdrawals if you're a U.S. citizen or green card holder living in India, Uncle Sam still wants to know, doesn't he?
He certainly does. The U.S. has citizenship-based taxation. That means if you're a U.S. citizen or green card holder, your worldwide income is generally subject to U.S. tax no matter where you live.
So moving to India doesn't end your U.S. tax filing duties.
Not at all. You'll likely still need to file U.S. tax returns, and distributions from your U.S. retirement accounts are generally considered U.S. taxable income, even if you're living full-time in India.
And this is where things can get complicated, because India might want to tax it too.
Potentially, yes. Which brings us squarely to the Indian tax side and that crucial double taxation avoidance agreement, the DTAA.
Okay, let's tackle the Indian side. First, who is considered a resident in India for tax purposes? It's based on days spent there, right?
Primarily, yes. India's financial year runs April 1st to March 31st. You're generally a resident if you're in India for 182 days or more in that financial year.
Pretty simple cutoff.
There's a second test, too. If you're in India for 60 days or more in the current financial year, and you were in India for 365 days or more in the 4 preceding financial years, you can also be deemed a resident.
60 days isn't very long.
It's not, but there's an important exception. For Indian citizens leaving India for work overseas or crew on Indian ships, that 60-day threshold is raised back up to 182 days.
Good to know. And they count arrival and departure days.
Yes, both count as days of stay in India.
Now, I know India has different types of residence for tax, ROR, RNR, and NRI. What's the difference, and why does it matter for our U.S. retirement funds?
It matters hugely for how your global income is taxed in India. RR stands for resident and ordinarily resident. If you're ROR, India taxes you on your worldwide income, everything.
Okay, RRR pays Indian tax on everything. What about NRI?
NRI is non-resident Indian. Generally, if you qualify as an NRI, India only taxes you on income that's earned, received, or arises in India.
So foreign income earned and received outside India
is typically not taxed in India for an NRI. This is often the key status for people moving from the U.S. regarding their U.S. retirement income. If you maintain NRI status, distributions from U.S. retirement accounts received outside India usually aren't subject to Indian tax.
And RNRR, resident but not ordinarily resident.
That's a middle ground off a transitional status. RNRs are taxed on Indian income, plus any foreign income from a business controlled in India or a profession set up in India, but generally not on other foreign income like U.S. retirement distributions received abroad.
So for minimizing Indian tax on U.S. retirement withdrawals, aiming to maintain NRI status seems like the goal, if possible, based on your stay.
For many people, yes, that's a primary objective from an Indian tax perspective.
What kind of income is taxable for NRIs in India then?
Anything with an Indian source. Salary for work done in India, rent from property in India, capital gains from selling assets in India, like Indian stocks or property.
What about interest from Indian bank accounts?
Depends on the account type. Interest on a non-resident ordinary NRO account is taxable in India, but interest on non-resident external NRE accounts and foreign currency, non-resident FCNR accounts, is generally tax-exempt in India for NRIs.
That's a useful distinction for where you park funds transferred over. Do NRIs get the same basic tax exemption in India as residents?
Yes, the basic exemption limit applies to NRIs too. If your Indian source taxable income exceeds that limit, you pay tax according to the Indian tax slabs.
Are the tax slabs different for NRIs?
The rates themselves are generally the same as for resident individuals under 60. Unlike residents, there aren't typically different slabs for older NRI individuals. India has the old and new tax regimes, each with different slabs and rules about deductions. NRIs need to see which applies or which they choose.
Okay, so maybe your U.S. retirement income avoids Indian tax if you're NRI, but any Indian income gets taxed. Now that double taxation avoidance agreement, the DTAA, how does it actually prevent paying tax twice?
That's its whole purpose. The U.S.-India DTAA sets rules for which country gets the primary right to tax specific types of income. For retirement income, it will outline whether the U.S. taxes it, whether India can also tax it, and critically, how to get relief if both countries do tax it.
Relief usually means a tax credit.
Often, yes. The main mechanism is the foreign tax credit, FTC. If you pay tax in the U.S. on your retirement distribution, the DTAA might allow you to claim a credit for that U.S. tax against any Indian tax owed on that same income, or vice versa.
So you're not paying the full tax rate in both countries on the same dollar.
Exactly. But figuring out which country has primary taxing rates under the treaty for different types of retirement income, like pensions versus lump sums versus IRA distributions, and correctly calculating and claiming the FTC, that's complex.
Sounds like expert help is needed there.
Absolutely essential. You need someone familiar with the specific articles of the U.S.-India Treaty covering pensions and Social Security and how they apply to 401ks and IRAs.
Are there Indian tax deductions NRIs might miss out on? Things residents can claim but NRIs can't.
Yes, there are some. For example, NRIs generally can't open new public provident fund, PPF accounts, though they can often keep contributing to old ones. Certain other specific savings scheme deductions might also be unavailable.
But some deductions are still okay.
Oh, yes. NRIs can usually still claim deductions for things like life insurance premiums, kids' tuition fees in India, certain health insurance premiums paid in India, depending on the specifics. It's not all or nothing, but you need to know which ones apply.
Okay, so we've covered U.S. rules, Indian rules for NRIs, the treaty. If someone decides, okay, I am moving funds, what are the practical steps or things to watch out for?
Well, the mechanics involve things like wire transfers, maybe currency conversion services, and setting up the right kind of bank account in India, NRE, for tax-free interest and easy repatriation, or NRO if needed, keeping in mind the taxability.
But the biggest practical point.
Understand the tax consequences in both countries before you move a single dollar. Seriously. Figure out the U.S. tax hit, income tax potential penalties. Figure out the Indian tax situation based on your residency status and the DTAA, then make the transfer. Doing it the other way around can lead to nasty surprises.
It really sounds like navigating this requires professional guidance. It's just too many moving parts.
It truly is. My strongest advice, honestly, talk to qualified tax advisors in both the U.S. and India, people who specialize in cross-border taxation, specifically U.S.-India issues.
Why both?
Because the rules in each country are complex, and how they interact via the treaty is even more so. You need someone fluent in U.S. tax law and retirement rules, and someone equally fluent in Indian tax law, residency rules, and how India applies the DTA. Your specific situation, age, account types, income needs, residency plans dictates the best strategy. What we've discussed gives you the landscape, but not the specific path for you.
Right. This is educational, not personalized advice.
Exactly. An advisor can look at your numbers, your goals, and help you choose between leaving funds, using SEPP, doing Roth conversions, maybe using Rule of 55 if applicable, all while considering the tax impact in both countries.
So let's quickly recap. We've looked at potentially just leaving funds in the U.S., keeping growth potential, but facing RMDs later.
We explored SEPP, substantially equal periodic payments for penalty-free early access, but with major inflexibility.
We discussed the Roth conversion ladder, paying U.S. tax up front for potential tax-free withdrawals later, but requiring a 5-year wait per conversion.
And the Rule of 55 for penalty-free 401k withdrawals if you leave work at 55 plus metries, but only if the money stays in a 401k.
Plus, the ongoing U.S. tax obligations for citizens abroad, the critical Indian tax rules for NRIs versus residents, and how the U.S.-India DTAA tries to prevent double taxation, often via foreign tax credits.
And the bottom line is, there's no single best way. It's deeply personal.
Absolutely. It depends entirely on your circumstances, your age, goals, risk comfort, and crucially, your residency status in India.
What works perfectly for your friend might be a terrible idea for you.
So as a final thought for you to consider, given this complex web of U.S. withdrawal rules, Indian NRI tax laws, and the layer of the U.S.-India tax treaty, what specific piece of this puzzle, maybe it's SEPP inflexibility, the Roth conversion tax hit, understanding NRI status, claiming tax credits warrants your immediate deeper dive with a financial advisor? Thinking about that one next step is probably the most productive thing you can do after listening to this. This is a major transition. Get the tailored advice you need. Thanks for joining us for this deep dive.